Welcome to Simple Investing Secrets, your trusted source for valuable investment insights, stock recommendations, and strategies to help you achieve financial freedom. In today's video, we'll delve into the 8 best undervalued stocks for 2024. So before we start, we kindly ask that you like this video and subscribe to our channel for weekly updates. Let's get started. The stock market is not a perfect system. Investor emotion can easily drive a stock's price higher or lower than it should be. Value investors play on that dynamic by seeking out underpriced assets to see gains when those stocks recalibrate later. Tune in to discover the benefits of investing in undervalued stocks. You'll also meet 8 stocks that could be candidates for your value portfolio in 2024. Understanding undervalued stocks. Undervalued stocks are company shares that are trading for less than their intrinsic value. The advantage of investing in undervalued stocks is that these securities often have an attractive risk or reward profile. If the company's fundamentals are solid, the risk is moderate, since cheap stocks with good fundamentals are less likely to experience dramatic and lingering price drops. The reward comes when the investment community realizes the stock's true value and the stock rises accordingly. Why stocks can be undervalued? There are several reasons stocks can be undervalued. Often the stock simply isn't very exciting. Investors can be easily drawn to companies that generate headlines or produce jaw-dropping growth. That leaves less money and attention for stocks that grow slowly and reliably. In other cases, the undervalued stock is under pressure from temporarily negative conditions. It's not unusual for investors to overreact in the face of bad news, prompting an excessive dip in the stock price. Whatever the reason for the conservative valuation, it equates to a discount on the stock. And the value investor sees that as an opportunity. Why? Because appreciation gains are derived from your cost basis relative to the stock's market value. In that equation, the cost basis is the factor you can control. Buying in at a temporarily low stock price better positions you for gains. Number 1. Berkshire Hathaway, stock price $363.62. Analysts' price target, $411. Berkshire Hathaway is a conglomerate that owns businesses in a variety of industries, including the insurance industry, the rail transportation industry, and the utility manufacturing industry. The company owns Geico, BNSF, Berkshire Hathaway Energy Company, See's Candies, and Pilot Travel Centers, among many other goods and services. Legendary value investor Warren Buffett is Berkshire's CEO and chairman. Under Buffett's watch, Berkshire Hathaway favors undervalued stocks. Key tenets of Buffett's investing style are buying low, investing in companies with moats, and holding assets indefinitely unless fundamentals deteriorate. Berkshire is an interesting investment because it provides exposure to a diversified portfolio of solid companies. Also, the Berkshire balance sheet is run very conservatively. The company holds healthy cash balances to protect against downturns and provide capital for further investment opportunities. A risk to consider here is Berkshire's future after Buffett departs. He's 93 years old. Buffett's right-hand man, Charlie Munger, passed away in 2023 at age 99. Number 2. Taiwan Semiconductor, stock price $100.39. Analysts' price target $111.25. Dividend yield 1.8%. Taiwan Semiconductor is a semiconductor foundry. The company produces chips under contract for clients like Apple, Nvidia, AMD, and Qualcomm. TSM is the world's most dominant chipmaker. The company owns an estimated 60% of the global semiconductor market. SEM also has long-standing relationships with some of the world's most successful tech companies. Admittedly, TSM's valuation metrics are less conservative than other options on this list. It gets the nod anyway due to its seemingly unshakable position in a market that's poised to grow. The demand for better, faster chips will rise as the world becomes more digitized and AI-driven. Analysts expect TSM to deliver revenue growth of 20% in 2024. Number 3. Tencent Holdings, stock price $36.93. Analysts' price target $212.50. Dividend yield 0.8%. PE ratio 13.3. Tencent, based in China, is a holding company that owns the popular social media and instant messaging platform WeChat, as well as related social media entertainment channels and online games. Tencent also provides online advertising, financial technology, and business services. Strong growth combined with a positive outlook and conservative valuation make Tencent an attractive option right now. Monthly active users on WeChat total 1.3 billion, according to Tencent's third quarter 2023 earnings release. Those users provide audiences for Tencent's advertising sales, which grew by 20% in the recent quarter. The company also grew its net profit margin, driving a profit increase of 37% over the prior year quarter. Number 4, Alibaba, stock price $70.14. Analysts' price target $124.80. PE ratio 9.9. Alibaba is another Chinese holding company that specializes in e-commerce and technology. The company's businesses provide online retail in China and around the world, digital entertainment services, and enterprise technology infrastructure. Baba's size and active user base of more than 1 billion make it a formidable competitor in online retail. The company's core business is connecting buyers and sellers on Taobao, Tmall, and other websites. Alibaba also operates the mobile payment app Alipay and sells advertising to merchants who want to appear more prominently on the company's marketplaces. Baba stock has trended down over the last year as the Chinese economy has struggled to recover from the pandemic. There are signs of a turnaround, however. In the September 2023 quarter, Alibaba grew revenues by 9% and operating income by 34%. Additionally, China recently reported 5.2% economic growth in 2023. At its current price, Alibaba has tons of upside as economic and business conditions improve. Number 5, Wells Fargo, stock price $46.59. Analysts' price target $51.15. Dividend yield 2.7%. PE ratio 9.8. Wells Fargo provides consumer and commercial banking services, as well as investment banking and wealth management services in the US and around the world. Wells Fargo has been working to recover from regulatory penalties for sales practice abuses. The Federal Reserve has imposed an asset cap, which is the company's main restriction. That cap stifles WFC's ability to expand its loan portfolio. That's the bad news. The good news is that WFC has a large retail client base that keeps deposit costs low relative to peers. Once WFC can resolve its regulatory issues and lower its compliance spending, the company can leverage its efficient cost structure to outpace its peers. This sets up a buying opportunity for the patient investor who can wait out WFC's current troubles. Number 6. British American Tobacco plc, stock price $29.87. Analysts' price target $34.33. Dividend yield 9.5%. PE ratio 6.5. British American Tobacco makes and sells tobacco and vaping products to customers around the world. Brand names include Pall Mall, Camel, Lucky Strike, and Newport. Tobacco stocks generally have customer loyalty on their side. They tend to produce consistent cash flows as a result. BTI, in particular, offers an impressive dividend combined with steady growth and a diversified product portfolio. BTI's cash returns above 9% along with its sub-7 PE ratio could justify a buy for yield-hungry dividend investors. The business also grew its EPS 5.3% in the first half of 2023, driven by strong performance in new vaping and oral tobacco products. Number 7, JD.com, stock price $23.86. Analysts' price target $44.57. Dividend yield 2.5%. PE ratio 11.6. JD.com is a massive online retailer based in China that sells everything from fresh food to home appliances. JD.com is 20% owned by Tencent and competes directly with Alibaba's Tmall. JD.com has invested in a tech-driven logistics infrastructure, including a fleet of delivery drones that fulfill product orders. That translates to faster and cheaper order delivery plus reliable order tracking. Add in a dedication to customer experience, and it's not surprising the e-com retailer has a customer base numbering in the hundreds of millions. In the third quarter of 2023, JD.com reported a 1.7% revenue increase versus the prior year quarter. Income from operations grew 24%, notching a new profitability record. The company also produces some $8 billion in operating cash flow annually. Number 8, Harley-Davidson. Stock price $33.46. Analysts' price target $45.25. Dividend yield 1.9%. PE ratio 6.9. Harley-Davidson makes and sells motorcycles in the US and around the world. The company also provides wholesale and retail financing to dealers and consumers. Harley-Davidson is the top US motorcycle manufacturer and owns an estimated 21% market share. HOG has an extremely loyal client base and strong brand recognition. Those qualities have helped the company manage through difficult macroeconomic conditions in recent years. Leadership's response to the tough times is its Hardwire 5-year strategic plan. The plan targets higher profitability and low double-digit EPS growth through 2025. HOG is also investing in its Livewire EV motorcycles and electric bikes to diversify its offerings. Third quarter results at HOG showed lower sales and profits, but the company is still producing a lot of cash, repurchasing shares, and easily funding its dividend. The disappointing performance is driving an 8% stock price decline year-to-date. This could be a buying opportunity for the investor who's willing to wait. Undervalued stock investing strategies. Heavy upfront research and analysis followed by careful monitoring are necessary when investing in undervalued stocks. To position your value investing portfolio for success, lean on the following guidelines. Number 1. Review the numbers. You can identify undervalued stocks by screening based on valuation ratios. These include the PE ratio, PS ratio, PB ratio, and PEG ratio. It's also smart to include debt service coverage ratios and cash flow history in your analysis. Review these metrics carefully relative to peers and the company's own historic values. This helps you quantify the opportunity and ensures your assets meet your technical requirements. Number 2. Understand the business and its key advantages. Business research helps you distinguish the best undervalued stocks from stocks that are cheap for a reason. You want to know how the company makes money, why it's successful, who the competitors are, and how the company is differentiated from those competitors. Number 3. Diversify. Diversification is the practice of holding assets that respond differently to market conditions. Doing so helps you avoid the scenario where every investment you own drops equally on the same day. You can diversify across asset classes, industries, company sizes, and geographies. You can also diversify by practicing different investment styles at the same time, such as value investing and growth investing. Exposure to growth-oriented stocks provides upside in strong economies, while your value portfolio can be a steadying force in more uncertain times. Number 4. Be patient. Value investing takes time. Often, companies are undervalued because they're going through difficult conditions. Months and years may pass before those conditions resolve. Be patient for those turnarounds, but also be ready to cut ties if conditions deteriorate. Undervalued stocks can deliver solid returns over time to investors who are willing to wait. Research your options carefully and choose investments with notable competitive advantages alongside those conservative valuation metrics. As a reminder, always conduct thorough due diligence before investing your hard-earned cash in stocks or the market. Don't forget to show your support by liking this video and subscribing to our channel for weekly updates on the best stocks to buy and cutting-edge investment strategies for building wealth. Thank you for watching, and may your investments thrive in the years ahead.